Hi, Jonathan York from Bay Financial Partners, looking at the investment markets. With the first US presidential debate now over, common consensus appears to be that Clinton came out on top. Trump appeared a little bit sort of disheveled, a little bit unprepared, and that has given the markets a little bit of sort of confidence out there, and we've certainly seen a reasonable rally on the back of it after a little bit of a sell-off but just prior to the debate. It's now going to be interesting to see how the last sort of 7 odd weeks of the campaign sort of unravel. But at the moment, it would appear that Mr. Trump has a little bit of work to be done. And most of all, it's just about convincing the markets that he is actually the man for the job. It's all very well sort of talking the talk, but at the moment he seems pretty light on sort of policies and really what is going to sort of take place if he was indeed to win the election. So I say markets rallied really on the back of that sort of first debate, a little bit of sort of improvement in consumer confidence. That obviously comes on the back of the Fed meeting last week, where again they sort of highlighted the fact that look, the US economy is doing okay. They do appreciate that rates are too low, and you're probably going to expect one rate increase now before year end. Interesting though, what sort of came out of the meeting as well, and it appears to have sort of flown under the radar, is the Fed's long-term predictions for interest rates. Back in 2012, they were predicting a sort of level of around sort of 4.5%. That's now been reduced to 2.9. Now that's obviously quite a major reduction there, sort of 1.6% in long-term rates reduction, and that has some pretty major implications for the economy going forward over the next sort of 5 to 10 years. If that is indeed the case, then rates are really going to be lower for longer. But also, as well, I say that sort of peak rate, which was forecast to be around sort of 4.5%, and normally sort of overshoots, so maybe sort of 5, is now going to be maybe sort of 3.25. That's really quite a major reduction in long-term interest rates. So that has some pretty major implications for global rates as well. Here in New Zealand, if that's the case, OCR is 2% at the moment. Predictions are that you might see one further cut down to sort of 1.75. But as stated, the New Zealand economy is certainly pushing on at a pretty reasonable rate. We've got a GDP growth above 3%, and with the increased dairy payout now, that's going to put quite a bit of money into the economy. And New Zealand is pushing on a reasonable rate. Trustpower got a bond in the marketplace at present. It's going to be 6 years, fixed at 4.01%. So if you're interested in that, call us on 0800 867 323. Also as well, here we've got Port of Tauranga share split coming up in October. Also got the Trustpower demerger as well. That'll be interesting to see how those sort of two pan out. I think common perception, certainly with the Port of Tauranga, is that once those shares are split and the share prices sort of falls accordingly down to around $4 from the current $20 on that sort of 1-for-5 share split, I think they might just attract quite a few sort of new investors at that sort of lower level. As usual, New Zealand investors looking for income. There are other options out there, and if you're interested in discussing the options that are available through high dividend shares, property trusts, etc., call us on 0800 867 323 or go to the website www.bayfinancialpartners.co.nz for lots of interesting articles, and we look forward to speaking to you soon.